Hello there, and welcome to our first quarter of 2022 update regarding the QOZ Fund, along with a Heritage Square update. Today, we're really just going to discuss the fund as a whole, specific with an emphasis on the Heritage Square. I know this was closed a little earlier than expected, but we always celebrate those fast and rapid closings. So let's dive in here. Really, we're going to start off here with a project timeline overview. So Dave, do you want to provide us with that?
Yes, thank you, Dominique. So if we look at our starting point of the QOZ fund, it goes all the way back to January of 2019. That's when we had our first deals on our contract. And we've looked at this timeline chart here almost every quarter since then to get an idea of where we stand. You can see our blue line here is December of 2021. So that's 3 years into the project or into the fund. And you can see at the end of the fourth quarter, we were almost complete with the station. We move forward to today. We definitely have some changes in what that looks like. The Lupton, for example, we're continuing to have delays there in our construction timeline. So that's pushing out this light green bar, which you can see is about 25 months now that we're projecting this total project to take. While at North Graham, our leasing time has been extended. We've been holding out on North Graham to really get some medical tenants in there. That will drive our value per square foot significantly higher than if we just have a normal, kind of call it any kind of operating business that enters that space. So we've really been looking for medical tenants there, and that's pushing out our leasing schedule on that asset.
So Dave, in the past, when we spoke about the Lupton, we talked about the windows being the delay here. Are there any other items that are causing delays at this project?
We've talked repeatedly about our windows and how long they took to arrive, and now we're installing them. We have a lot of them installed. We're about 60% done there on the windows, but we also have our elevator system. The Lupton, it was built in 1908, so it's an older building, and we took out the elevator cars that were in the shafts and built new ones in there. The time to actually complete that and get them up and running and permitted and with approvals and everything, that's taken longer as well. It hasn't outpaced the windows though. So if we think, which one's really longer, the windows are longer, but the elevators are certainly something that is behind schedule. We pushed our completion date out here until June now. Again, that's 25 total months to do this renovation project, and we're confident that we can have both of those factors done in that time frame.
Right. So what does that mean for cash flow, specifically on this asset?
So cash flow, for the most part, the Lupton is totally vacant. So there's no cash flow coming in on that one right now. And we're spending about $20,000 a month on the minor operating costs we have and the debt service that's in place. Now that debt service cost keeps going up as we fully draw down the loan on the Lupton, which we're almost done with. So we're almost at a fully drawn loan, and therefore our interest expense compared to when we originally started the project is about twice as much. So we're going up towards, when we're done, we'll be up towards $18,000 a month versus around $9,000 a month when we started.
Right. Let's jump into really the fund-wide revenues here as they continue to grow. We always love to see that.
Revenues are always positive, right? We want to see revenue growth. And we look at this chart since inception. When we first started in this really second quarter of 2019, when we had deals that we had closed on and were working, our revenue has continually grown. And if we look at the fourth quarter of 2021, we had revenue growth, and along with the first quarter of 2022, we're continuing to see our revenues increase. Jumping into specifically the residential segment here, we have revenues that are almost at $500,000 a quarter now. We hit $493,000 in the fourth quarter. 4 quarters we've had break-even cash flows. So we've done pretty well here for 4 quarters now, adding cash to the balance sheet on our residential assets.
Dave, you mentioned break-even. What does break-even actually mean?
Sometimes that's a tricky question, but yes, that's a good one. Our break even, and what we mean by saying we are positive cash flow, that's all revenues minus our operating expenses, capital expenses, and debt expenses. So we're cash flow positive when we consider that. That does not include our investor payouts. So that's has nothing to do with our prefs or profit returns that we have. It's just operating and capital improvements that we are making on a specific deal.
I want to shift into everyone's favorite topic, rental rates. Do you foresee that continuing to increase? What are our thoughts here?
We definitely see it continuing to increase. All this talk around inflation going up, really post-COVID, rental rates across the country have risen pretty dramatically. We're currently seeing 3 to 4% per quarter. So that's double-digit rental growth per year that we're seeing in all markets that we operate in on the residential side. So we're definitely seeing a lot of growth in that. I mean, even if we look at some of the commercial assets, those two are seeing revenue growth. More specifically on like the industrial or the medical side, they're seeing revenue growth from rental rate increases in the market. Another good point we have here is just occupancy. On the residential side, we're at 96% on our portfolio here. That's very strong. We always want to have a few vacant units so we can capture what those market rent increases are. We had a dip in the third quarter of 2021. We were down to 92%. That was really around some heavy late payments at specifically Heritage, which we're going to jump into as we exited that asset. But we had a lot of late payments there, and we had some at Fairway as well, which pushed down our Q3 occupancy, and we are now recovered from that. We're sitting at 96%. On the commercial side, you can see here our revenues are pretty flat. Even since inception, the first asset we had that had revenue was the station. The Lupton and North Graham are both still vacant. So we've had some revenue gains here from 2020 into 2021.
Yes, some good news at the station. We've been talking about our Greenleaf expansion for quite a while, and those plans are finally underway. We'll be taking over some additional space here in about a month. And then after that, we'll occupy some more space, but that will take us about 6 months as we need to do some build out there to accommodate our needs. And once we've completely moved over into the new space, that will increase the station occupancy by approximately 5%.
Yeah, we're excited about that because we'll go from about 38% occupied on the portfolio to 43% on all of our commercial space. On the other side, that takes us up into the 70s at the station. The majority of the vacant space we have left at the station is really this unbuilt out space. If you've been to any of our investor events, we've had events in those areas and they work great for that, but we have not been able to lease any of the what we call white box kind of space on the commercial side. So we are taking some of that space. That's when Natalie mentions it's going to take us about 6 months to fully build that space out. That's what she's referring to. And we're also taking some additional just built out space that's already at the station. So that's coupled together really going to drive the occupancy there a little bit. And it's, Greenleaf expanding. I think we hired 3 new team members this week too, across all aspects of accounting, on the leasing side and on the maintenance side too. So we're excited about that. And with that growth comes the need for a little bit more space, specifically from our team.
I want to put in a work order request to specifically have mini fridges in every room.
In every
Fully stocked to the brim.
We have a snack section now, which is good. That's thanks to Megan. We've got that set up, which is awesome.
We had on schedule to talk about the commercial occupancy. Can we dive into that a little bit more?
Yeah, so we're at 38% overall, and really it's just getting the Lupton and getting North Graham occupied. Lupton finished and then leased, and then North Graham we've been holding out for a medical tenant. We definitely feel that long term, if we have a medical tenant in there, the asset's going to be worth a whole lot more than any other tenant that could fit in that space. So although we do want to lease it, we really want to make sure we maximize our value in this, especially for the long term. On North Graham, one thing that is exciting is we have our solar panels installed and up and running there. We put a system in. It's not a battery-based system. It's just solar panels that are then going directly to the grid with that power, and it's offsetting the current energy we're using. Now, we're not using that much simply because it's not occupied. So in our lease structure there, though, utilities will all be lower, so we will be able to capture the benefits of that. But here's just a little look at what the overview of the solar system looks like. We can see every day how much energy is being produced. We can see the benefit that we receive. which is really if you say our utility bill is $1,000 for the month, and we produce $200 worth of utilities, we'll see that credit on our bill, and it'll come down to $800. Our utilities are lower than that right now, but that's just an example of how it works in North Carolina. So if we look at our fund value as a whole, we've gone through this slide some before, and we're just showing what we purchased assets for, how much we put into them, and then what our current estimated value is of the fund. So we had about $36 million go into this, and we're pegging our current valuation at $45 million. So that means we've made about $9 million in value in the fund. So obviously that's positive. We invested $12 million. So our goal in this is to double our initial investment. If we look at a 10-year hold, earning a 10% pref, that means if we invested $12 million, we need to generate $24 million to meet our pref over a 10-year period. And so right now we've made about $9 million. So we're doing well on the value creation based on what we currently see out there. And one of these we just realized, which is going into the sale of Heritage Square. So this asset, this was a fast one.
Certainly. So this closed March 4th. All of our investors, both QOZ and non-QOZ, received that closing communication the week of March 15th. And here really we're going to dive into the impacts, QOZ and non-QOZ, of course, of the sale and what our use of proceeds are for the Heritage and Fund.
When we look at the Heritage exit here, we're in a deal that this was the fastest construction project we'd ever done, taking a building that was for the most part vacant, should have been vacant, to actually being fully vacant, renovating the whole thing, doing the fastest lease up that we've ever done. As soon as this was done, we had this thing leased and occupied very quickly. And then we ended up selling it. We got some good offers here. We had some issues with delinquency on this asset, and we determined it could be a good option to sell it, and we sold it very quickly. So overall, this was basically under 3-year hold to fully renovate, lease, and sell a deal. That's the fastest we've done all those things, which was very exciting. When we look at the impact this had on the fund and on this specific deal, so overall, it generated about a 27% IRR over that 3-year period. Our sale price was $4.7 million. That went out in a lot of the updates that Dominique had sent out. So you see that from our March 4th sale date that our $4.7 million sale price went out. We repaid all of our loans. We had some closing costs, and we had some cash and AP that were on the books already. So overall, our net proceeds were about $2.7 million. And from that, this deal was interesting in the fact that it was 86% QOZ cash, 14% non-QOZ cash. So we had some fresh equity investors that joined into this deal because it's very similar to a lot of the other Greenleaf deals we've done, where we took an asset, renovated it, and leased it up. In this situation, that represented about $1.1 million from QOZ and just over $200,000 from non-QOZ. Both participants in this deal had a 10% preferred return. So the non-QOZ component, they received their preferred return, and that generated a total basis that they need to be paid back of $292,000, while the QOZ, granted we had preferred return there, but it's more at the fund level. When we look at these two factors here, we have a total combined equity investment plus preferred return of $1.75 million. So that generated $993,000 of profit on the sale, assuming that this 10% pref number comes from both non-QOZ and the QOZ fund. And now we want to look at how the QOZ cash is impacted from this sale. With the QOZ, there's not a GP profit sharing currently. That's not done at a property level. It's done at the fund level, and only after we hit our full 10% pref for a 10-year period. So the GP profit share is a ways out on the QOZ fund. It's not happening anytime soon. Whereas the fresh equity investors, that profit sharing and the profits to LPs happens right now as their cash was distributed back to them. So on the LP side, those individuals received their cash distributions already for this deal. The QOZ side, we had our initial equity of $1.12 million. We have our pref that built of $328,000 and profits allocated to the QOZ of roughly $829,000. So overall, the QOZ fund received $2.28 million in cash that went into the fund itself. None of that money was distributed to the GP. None of that money was distributed back to investors. It's all left at the fund level. So that certainly makes things interesting. There's a lot of questions that come into what does that mean if it's just left at the fund level? What's the cash doing? Where's it going? What distributions could we see from that? And in general, the strategy of operating the QOZ fund is that the cash stays within the fund and we reinvest it and keep pursuing new QOZ deals to compound the growth of that revenue. Overall, the QOZ cash that we have, there's a couple rules that follow into how this works. The cash has to be, so QOZ funds are not allowed to just hold cash. That's not how it works. It has to be invested into a qualifying asset. And a qualifying asset is one that's in an opportunity zone. So we have 360 days to redeploy the cash we earned into another opportunity zone project, which will then keep it as a qualified asset. It keeps the QOZ fund going. We get to compound our returns. There are other rules at the QOZ level for a fund that state we cannot hold more than 10% of just cash. So we can't just sit on cash and not do anything in the QOZ fund. We are required to and will deploy it into other QOZ investments. Okay, so a couple other upcoming things. We have this summer, we're envisioning refinancing the Grove project. We have about 10 months left on the loan there. The deal just keeps getting better and better as revenues are rising and it's being more and more financially positive cash flow. So we'll be able to get a better and better loan. So we've been holding out on that one. We're kind of getting to the end of our time frame here, but we plan to have that refinance done in the summer of 2022. By the fall, we are expecting, if you go all the way back to that first chart we had, we are expecting that our North Graham lease up will have leases signed and we'll be able to complete the refinance on that one in the fall. And then Lupton, we're probably looking at 2023 to do that refinance. Now, all this cash that's generated from refinances and the Heritage sale will be redeployed into QOZ opportunities. I know they've been getting a little trickier to find, but we also haven't been really digging into them simply because we know we've been waiting to generate this cash so that we could have opportunities to do it. Before, we didn't have cash in the QOZ fund to go make new investments. So now that we have it, we have our 360 days to identify additional assets that we can purchase in the QOZ fund.
For that reinvestment plan, do we know what assets in the fund currently could use the cash and how we are going to reinvest those proceeds back into the fund?
Yeah, that's a very good point. So in the middle of COVID, we redid our reserve strategy across all of our deals.
Right.
So we went in saying, hey, we need to make sure we have X amount of cash per deal consistently across all of them. Typically, our deals that are in the renovation stage do not meet those reserves. So the current cash that we have on the books helps all of those assets meet their current reserves, and we can use it for that, but we're not really using it. And then the other side, when we do the refinances, we're going to have more cash that we have to deploy. So,
And I assume any cash sitting at the reserve level meets that 10% cash percentage you mentioned earlier, correct?
right, all of that cash counts to our maximum amount of 10% cash.
Gotcha.
So if we invested, we invested $12 million in the QOZ fund, we can't hold more than $1.2 million of cash. Even if we call it reserves, the IRS is looking at that saying, you can't have more than $1.2 million. It's still cash. Exactly. So we have to, we have more than $1.2 million right now in cash. So we will have to deploy that within within the time frame this year, so we don't just sit on too much cash.
It's a nice problem to have.
It is a good problem to have, but it's also, we don't want to, get penalized for holding too much cash. So we'll now actively look for what QOZ opportunities we can find.
Feel optimistic about finding them?
Yeah, there's lots of them out there. So I certainly think we'll be able to find some and have some good options that we can put this money into within the QOZ fund.
Excellent. Well, this does conclude our QOZ update for the first quarter, as well as the Heritage Square update. We do appreciate joining us today. If you have any further questions regarding this QOZ fund update or overall strategy, please feel free to email us at invest@greenleafmgmt.com, and our investor relations team will be sure to answer any questions that you may have. Thanks again, and we'll see you soon.